So welcome. My name is Geoff Dohrmann. I'm the President and CEO of Institutional Real Estate, Inc. And I'm talking today with Steve O'Connell, who heads up Grosvenor, USA. And it's an interesting story. And so we thought we'd clue you all into what they're all about, how they've developed over the years, and their presence in North America, and where they're focusing now. So if you could, just help us understand a little bit about the history of Grosvenor. When did it start, and what does it represent, and all of that?
Sure. Let me take a shot at that. It's a long history to try and summarize. I guess I'll start with us. We're Grosvenor Americas. So we represent the North American region of the International Property Company. There's also a region in Europe. There's an operating company in Asia, and then there's the operating company in the UK. And it's really in the UK where the company's longer history lies. The company's been around for 340 years, and it's been continuously developing, redeveloping, and investing primarily in areas of central London, and specifically Mayfair and Belgravia, and up to a certain point in time, Pimlico. But it's really been centered in those parts of central London for the last 340 years. And in fact, when they began working and developing what's now known as Mayfair and Belgravia, they were essentially marshy agricultural lands on the outskirts of London. And the family over many years has done a fantastic job of developing and improving and placemaking to create the neighborhood that is now Mayfair and Belgravia. So they've done quite well over time. It's been privately held and held in a single family throughout that entire 340-year history.
So it's really a family office of, and who are the owners?
The owners are the Grosvenor family. So the name of the company is the family name. The ultimate shareholder is the 7th Duke of Westminster, and his family has been in continual ownership of the land for all this 340 years. Wow. It was in the 1950s that they made their first international expansion, and that's where the Grosvenor Americas story starts, because in the 1950s, post World War II, the family looking for some international diversification, they came to British Columbia in Canada and acquired a large island called Annacis Island, and essentially developed Canada's first industrial park on Annacis Island. And we still have relatively significant industrial holdings today on Annacis Island. And that represented the first move abroad for the company. So up until 70 years ago, it was purely focused in the UK.
And how long have you been leading the effort in the United States, or in North America? I suppose it's more than the United States.
Yeah, we're in both Canada and the US, and I've been with Grosvenor for 10 years. I took over my current role as chief executive around 2.5, 3 years ago. And prior to that, I started off in our San Francisco development team, and then I spent a few years working with our investment and SDF programs before taking on the current role. So I've been here for 10 of the 70 years we've been in North America.
And you've mentioned that you've got a global infrastructure with a property company in Europe. You've got a property company in Asia Pacific, as well as in North America. How do they all interrelate with each other?
That is, I really like the way that the company has structured their international operating businesses. The structure the way they refer to the structure is as a devolved structure. And what that means is that each of the international operating companies are given certain financial criteria that we need to maintain. Things like maximum debt ratios and liquidity requirements. And provided we maintain those ratios and those requirements, we are then given a lot of authority to act locally. So in my example, it's here with the North America. Provided we were holding those covenants and meeting those financial requirements, we essentially have our own capital that we manage here. We've got our own board. We set our own strategic plan, and importantly, we do our own deals. So when we're acquiring land or properties, that's all handled locally. And what I really like about this is the, the, the governing controls are put in place to ensure the very, very long-term success of the company. And provided we're meeting that, we then have the authority to allow the local real estate experts, where we really know our local markets, we're able to develop our own strategy and do our own deals, basically. So I think it's a great way to allow local expertise, but also ensure the long-term survival of the company.
Yeah, and you're a member of our Institute for Real Estate Operating Companies, so
Yes.
I assume a lot of what you do, if not all of what you do, is oriented towards joint ventures with local operating partners. Is that correct?
Yeah, we've been, I mean, the whole 70 years that we've been operating in North America, we've been doing it with LP partners by our side the whole time. And, you know, over time, that's contributed to our investment portfolio. So we've got a $3.6 billion portfolio of investment assets now, and the vast majority of those are owned with some of our historic partners. So our average partnership relationship now is probably around 20 years. And we've got our longest partner, for example, we've been together with him for over 40 years. So we've got a long history of being the GP for like-minded LPs. And I joined your group, Jeff, a few years ago because I'm interested to make sure that we're always keeping our eyes on the horizon for, you know, one or two potential new partners to join us, people who have a similar mindset and are looking for similar long-term returns.
And are you looking for operating partners, or are you looking for capital partners, or both?
Capital partners primarily. We are generally the operator in everything we do. We have development teams, construction managers, we've got asset managers all in-house. So we've got full teams of operators. The one small area where we do work with GPs is in a program that we have, the structured development program, where we provide either mezzanine or in some cases joint venture equity to residential developers, where their development sort of falls outside of our own self-development targets. So either projects that are smaller or in different locations that we're not developing, we do have that SDF program. And that is the one area where we do look for GP partners.
So tell us a little bit more about your North American program. You've got different angles, the way in which you're accessing markets, doing things. And how has it evolved over time from those first initial industrial property transactions that you did up in Vancouver in the early days of the company?
Yeah, that was one of, when I took on my current role, I took a little sidebar, a little tangent, and I kind of dug into our history here in North America just to learn a little bit more about it. And it's been pretty interesting. What I've found is that we've been quite opportunistic over time and over the years. So we landed in Vancouver in the 1950s as an industrial park developer. And from there, we took our development skills and started developing some residential and retail in Vancouver. In the 1970s, we went to Hawaii and we're doing office towers and development in Hawaii. And at that same time, we came to California. And in California, we started developing and purchasing office as well. Through the 80s, we were in partnership with several British pension funds, and we got quite aggressive in office acquisitions. And then going into the 90s, we got into retail, which was, I think, a good thing to do in the early 90s, late 80s, early 90s. At one point, we had 16 large format malls and shopping centers all across the US. We then, as we started drifting into the 2000s, scaled that entirely back. So we now have no shopping centers as of early 2000s and really shifted our focus towards residential. So we've been in this residential groove now for probably 15 plus years, 15, 20 years. And we've been touching on it in all three of our business lines. So to answer your question about our activities, we've got three revenue generating parts of the business. The first is our development teams. We tend to develop residential product that's of the higher scale of quality and typically in the urban centers where we're active.
This is all multifamily?
It's multifamily and condo, and particularly in Vancouver, we have a very heavy condo approach. And that's because the pre-sales environment in Canada and specifically in Vancouver is fantastic. It's a great way to develop. So our development teams are active in Vancouver, San Francisco, Washington, DC, and now Seattle. That's one line of business. Another line of business is our investment program. We've got, as I mentioned, a $3.6 billion portfolio. It's around 62 properties. And they're a pretty good mix of product types, things that we've acquired through all of those phases of history that I described. And our asset managers tend to be quite focused on adding value. So within that portfolio, we're constantly culling it and rotating properties through to make sure that the portfolio is evolving as well. So that's the investment program. Over the last 10 years, we have opportunistically bought office and retail, but more predominantly focused on residential. And then the last program is that structured development finance program I mentioned, mezz and some joint venture equity. We just actually last week closed on our third iteration of that fund. It's a programmatic venture. We've just re-upped with a couple of historic partners, and that program's been up and running for 20 years. And it's been great. It's been really resilient for us, particularly in this last recession. So let me see, in terms of our business, we're 110 people. And we have 3 offices today: Vancouver, San Francisco, and Washington, DC. And I think the only other thing I'd maybe say in terms of introductions is just we have been taking a pretty aggressive approach towards ESG initiatives for at least the last 5 or 6 years. So that's been a big part of our thinking too.
And we'll circle back to that in just a minute. Right now, I'm kind of curious as to how you guys have managed your way through the pandemic. It's hard to be as hands-on as you are when operating in a lockdown. How have you morphed through that whole process?
Yeah, I guess it's only now that we're coming out the backside of it that I'm starting to come to terms with how dramatic and how unusual this last 18 months has been. Last week, I went to my first in-person conference. It was the UC Berkeley Fisher Center conference. And as I was sitting there watching Ken Rosen's economic slides and his real estate impact slides, and just talking to other people in the conference, it's just becoming more and more clear to me how extreme that last year was. So for us, we certainly were put through the paces. I guess our first focus was on our people. And we wanted to make sure that our teams were all engaged and informed and connected with each other so they could do that hard work that they had to do last year. Those large urban cities where we have offices were pretty strict about their lockdowns. So we were essentially all remote this whole time. And it was a very heavy year for our asset managers and developers. So wanted to stay focused on the people. But we also felt stress in certain parts of the portfolio, specifically some of our retail assets where we went out and voluntarily deferred rent last year. On our development projects with managing our construction sites and our sales and leasing activity, there was definitely a lot of work to be done in those areas. But then there were other bright spots of the portfolio, which is our industrial and residential holdings. So at the end of the day, it was an extremely unusual time, but we, kept the train on the tracks, and it's been quite manageable, surprisingly manageable, the impact to us. And we're finding ourselves in a pretty solid financial position right now. And in terms of your question on how have we morphed, it's obviously this last year has been an accelerant of a lot of things. And we are an urban real estate company. And we're focused in those larger gateway cities that I mentioned, San Francisco, Vancouver, DC, Seattle. So it really forced us to sit back and challenge ourselves and think about, what about our markets? How are we doing in our markets? And what product type should we be looking at? And I think the market one is probably where we spent the most time working with our research team, because there's clearly disruption happened to the urban centers. But having put ourselves through those paces and challenged ourselves, we're feeling quite strong now and quite confident that there will be a resurgence back to our cities where we're investing, and that the fundamental, employment drivers and the attributes of those cities and the barriers to supply that they present are going to ensure that the real estate performance will be there in this next cycle. So we've challenged ourselves. We're remaining committed to these cities where we've been active for the last 20 or 30 years. And on the product side of things, we do have products in each of these cities, or in each of the product types in our investment portfolio. So we could pivot to different product types if we wanted to, but just seeing the supply constraints on residential nationally, and then very specifically in our local markets, there's just a lot of demand there. You can see it with what's happening with home values. So we're going to stay focused on residential as well. We've got a lot of experience to bring to the table there.
So it sounds like post-COVID, your focus is going to be pretty much, at least for the time being, on what you've been doing, focusing on the residential sector.
Yes.
But with some flexibility to move in different directions if events should unfold that suggest that that makes more sense to do. Exactly
right. I mean, it's a time of great uncertainty now. So we feel very confident in what we're doing, but we have the ability to change. As I described, over the last 70 years, we've been constantly moving and evolving. So we put ourselves through that challenge. Is this the time for us to move and evolve? And just based on what we're seeing at this moment in time, we want to stay focused on where we've had this most recent experience. And, you guys are basically investing money on behalf of a family office in their balance sheet, but you're also raising capital from third parties through separate accounts and fund vehicles and joint ventures. I wouldn't ask you to name names, but maybe characterize for us the types of investors that have partnered with you, invested in your funds and those sorts of things, and maybe even who you compete with when you're raising capital. Yeah, I'm happy to do that. And as I mentioned earlier, we tend to have fairly long-term relationships, so we don't have a great deal of churn. We are managing private capital. And as I mentioned earlier, through our devolved structure, we do have our own capital here in North America that we essentially can control, and we can plan what our activities will be. So with that, our partners have the strong and vast majority of our partners are pension funds. We have a UK-based pension fund, and we're currently partnered with 3 Canadian pension funds as well. So most of our larger scale activities is in partnership with pension funds. However, we also have a few relationships with some high net worth family offices as well. And both of those have been fantastic. We've kind of gotten into a groove, and the relationships have endured. So those are the types of relationships we're looking for. Just to your question about the structures we use, we actually typically do not use fund structures. Our preference is programmatic joint ventures, where we kind of agree up front with what we're looking for, but then all of the partners have the opportunity to approve on a deal-by-deal basis. And that's worked well for us, as I said, over decades of relationships with the partners. So will you have multiple partners in each deal, or will you have specific partners for each deal? It's a bit of a mix. Predominantly specific partners for each deal, but we do have a partnership of 2 pension funds where we, Grosvenor Americas, and the 2 pension funds are each equal partners in the venture, and that's worked out really well as well. And same thing with the structured development finance programmatic venture we just closed last week. That's 3 partners. So it's a bit of a mixed bag. It's either 2 or 3 partners or a single partner working with us. Okay, now we talked earlier, you mentioned ESG and a commitment to ESG. Right. And it seems like lots of people are jumping on that bandwagon. Yeah. The question sometimes, is this just window dressing, or are they serious about it? And if they're serious about it,
what's driving that? I mean, what are the values of the organization that drive you towards that?
Yeah, that's yeah, the greenwashing question is definitely out there. And this is one area where I think we have really benefited from being part of an international group. Um, as I described, we have a lot of autonomy from a deal perspective locally and from a strategy perspective, but we benefit from experience sharing with the other regions. And it seems very clear to me that Europe and the UK are significantly ahead of us here in North America as it relates to ESG. So it was, I don't know, for the last 10 or 15 years, we've been reporting and disclosing on our environmental, reduction efforts, our sustainability efforts. But in the last 6 or 7 years, we really kicked it up a notch. And it's being driven by essentially the families and the family office's desire to make sure that we are, while we're out there, generating commercial benefit for the shareholder, we're also generating social benefit. So we've really amped it up over the last few years. In 2019, we signed up for the World Green Building Council Net Zero 2030 carbon commitment. So that is us essentially committing to bring our whole portfolio to net zero by 2030. And we signed up in 2019 and we're still madly working on it. As operators, there's a lot of work for us to do in the portfolio. And on the
is it an achievable goal, do you think?
We think so. Yeah, our primary focus now and probably for the next 8 years is going to be to let's take all our properties and do what we need to do to have them become as sustainable as possible and as low impact as possible and have them generate as much power as possible. And then beyond that, you can look to renewable energy sources for remaining, any remaining energy needs that you have. And then ultimately, as a final desperate measure, there are carbon offset credits you can purchase. We're just focusing as much as we can on how can we cut emissions and increase our solar generation. That's our first phase. But between those 3 steps, I do think it's achievable, but it's a lot of work. Last year, during the pandemic, we took one of our senior real estate people from our San Francisco development team, a woman named Lauren Krause, and we promoted her to full-time ESG director. And it's been a big part of her role to try and advance our efforts to net zero carbon. It's as an operator, it's a significant thing that we've signed up for here.
Another thing, we didn't talk about this before, but another thing that is grabbing the attention of investors today, particularly in light of some of the developments that have occurred with, resurgence of racial awareness and racial considerations. DEI, is that on your agenda as well?
Yeah, 100%. So again, I feel like we've just gotten this great head start because we're part of a European international business. So I think it was back in, I don't know if it was 2017 or 2018, we put together what we refer to as EDNA instead of DEI, but it's the same thing. We put together an EDNA group, which is comprised primarily of volunteers from within the company. And we've been working on initiatives, and a lot of it has been generated by our staff to look at things like our hiring practices, our recruiting practices, making sure that we have an inclusive environment in each of our offices. And we currently have, of the 110 people, we currently have 42 people who are volunteering to contribute to our EDNI efforts. So it's obviously the right thing to do, and it's obviously very timely, but what I'm also finding is that it's a really big motivator for our people. Our staff are really engaged in this, and I just think it's fantastic.
Now, some people have pushed back on it and said, it's almost like affirmative action in some respects, and it's forcing people to do things that may not always end up attracting the best talent. And it's somewhat insulting to some minority groups that feel like, why can't we just do this based on merit? Why do we have to have these programs in place?
Yeah, I think So first and foremost, things will be done based on merit. There's no doubt about that. I mean, that's the only healthy way to move forward. However, you also have to acknowledge that there are things, processes and systems that have been in place that haven't contemplated this historically. And we can do better. We can make sure that our hiring practices are blind so that we are getting the top talent and that it is merit-based. There's just a lot of, I mean, in terms of people thinking it's not fair and you're going to end up with subpar staff population, for me, it's like that's the polar opposite. If we have a highly inclusive environment where we're able to attract and retain the top talent, regardless of what they look like or anything, we are going to outperform. So for me, this is about higher levels of performance, period. And I can see it and feel it already in the work we've done. So I know that narrative's out there. I know there's skeptics out there. I personally can't waste my time.
Well, actually, I think it's few. It's not large. I think.
Yeah, I agree.
Some people are questioning it. They tend to be more libertarian in their viewpoints.
Yes.
And kind of oppose anything that is smacking of, mandates.
Agreed. And this is not about mandates for us. This is just making sure that we're optimizing our workplace. And I mean, I'm finding such staff level support and such morale boost from these activities. It's fantastic. Yes, we have 110 people. There are probably as you're describing, a very few skeptics, but we can't let that get in the way of the very positive culture benefits that we're getting from all these activities.
Okay, I want to end on one point,
sure,
which we've touched upon. But you said that one of the reasons you joined IREOC is to connect with potential future partners.
Yeah.
You also mentioned that your partners have been very long-term.
Yes.
So could you paint a profile of the perfect partner that would fit into a slot? What would they look like?
Yeah, I guess what we're looking for are partners we always refer to like-minded long-term partners. And I guess what we mean by like-minded is we want to do things that are a certain level of quality for reputational reasons and also for economic reasons. We want to do things that are going to have some positive social impact. And we want to do things where we're going to be able to benefit from them over a longer term. So that's sort of our vision. That's the way we operate. We're focused on quality and brand and long-termism. And I guess the ideal partners will be ones who have similar mindsets. And I think that's why we found ourselves gravitating towards pension funds who do have those longer-term obligations. They're very focused on reputational risk. And they want to make sure that their activities are making a positive long-term contribution. So I think those are the type of partners we're looking for, Jeff. People who are like-minded.
And how much capital do they need to be prepared to commit on an annual basis to programs that you offer? Understand that they're not bound to, but they have.
Yeah. Particularly because we do things in a programmatic way. There's no binding going on, that's for sure. But at this moment, as we come into this recovery, we've just closed our SDF programmatic venture last week. We've got two other ventures that we're raising for. One on the development side, which is to build to core urban residential in San Francisco, Seattle, and DC. The equity commitment we're looking for over the investment period is around 200 to 250 million, somewhere in that range. And similarly, we have a value add investment program, which we can invest with, and it immediately produces income while we're adding value. That's a similar $200+ million commitment, again, over the investment period. So we would envision that the dollars are going out in years 3 through 5, and then we're starting to get the benefits towards the tail end of 7 to 10 years. So it's that time horizon and roughly that scale.
And it could be also a family office.
It could be, yeah. I mean, again, in our investment portfolio, we have several, I'm thinking 3 or 4 relationships with very long-term family office partners that we've worked with for decades now. anyone who's got that sort of long-term mindset in terms of long-term returns, that's probably where we play best.
So is there anything we didn't talk about that we should have talked about?
No, it's been great. I particularly enjoyed catching up with you at the beginning before the recording started, Jeff. So I think that gives a pretty good snapshot of where we are. You know, we've come out of the pandemic. We've kept the trains on the tracks. We've challenged ourselves. We're now feeling very committed to what we're doing looking forward, and we're just wanting to see if, in order to continue our history, if we can add one or two more partners to our line of partners we've had. Great.
Well, Steve, thanks for joining us today. Appreciate it, and thanks all of you for tuning in and listening. I hope you learned a little bit about a historical player that's been around for a very, very long time, certainly longer than most of the people involved in the pension real estate investment business. And I thought that would be interesting to bring to your attention. So thanks for joining us.